Hello, everyone. We're excited to have everyone here join us on our webinar today. Our topic today is discussing a little bit about our value equity strategy and thinking about how this can be driving a value cycle through the climate crisis that we may be seeing. I'm excited to be joined today by Sam Peters, who's one of our portfolio managers at ClearBridge. I've worked with him for well over a decade, close to 16 years, so I'm very excited to be able to bring him to everyone to hear his thoughts. Sam, before we get into the topics of our webinar, I would love for you to share your background and philosophy and how you go about looking for value stocks within the portfolios that you manage. And for us at ClearBridge, Sam is a co-portfolio manager on our Value Trust. For our U.S. clients, our non-U.S. clients, it's referred to Value Fund, but you are also part of an all-cap portfolio called All Cap Value. So, Sam, thanks for joining us and love to hear your thoughts.
Yeah, thank you, Kathleen, and really appreciate the time from everybody on the line. Thank you. So, real quickly, my background is I grew up in a ranching and oil and gas family in New Mexico, and then went east for school. I studied statistics and economics at William & Mary and University of Chicago. And then I worked at Fidelity for a while, and then I've been here, fortunate to be at ClearBridge for 17 years. One thing, when you grow up in an oil and gas business, you get really good appreciation for cycles and the powerful arc between fear and greed. It's kind of imprinted on me. And my grandmother used to literally tell me when I was young, she'd be like, ultimately, everything is cyclical. I think that really imprinted me strongly, and I think it's true, and people always forget. I'm on ClearBridge now. I've been part of an excellent team here for almost 17 years, as Kathleen alluded to, and everybody that I work with, we've worked together for 15 to over 20 years. And I think one of the great strengths of ClearBridge is this longevity. On Value Trust, which is a large cap value, my co-PM is Jean Yu. She's an MD PhD, super smart, and happens to be as intense as I am. And then on All Cap Value, I have two great co-PMs in Reed Cassie and Albert Grossman. And we're all co-PMs in the true sense of the word. We challenge each other, we disagree, we learn from each other, we evolve. It's a really good environment, intense environment. We work hard, but it's a great environment. And then we have an excellent team beyond here, beyond Baltimore, throughout the ClearBridge platform up in New York and Central Research and all the other PMs. So it's just an incredibly hardworking group and focus on long-term investing. One thing that we share in Baltimore, hence the value side of this, is we have a common valuation process. And we think everything is about price and value convergence. So we buy when we think something's below business value, and we try to figure out what could bring price and value together, and that's what drives returns. What we really do is it's embedded expectations. We invest when we think future fundamentals will be better or good fundamentals will be sustained for longer than what the market currently embeds in the price. And opportunities, we think for all value investing, we think opportunities are behavioral in nature, which is lasting. And I think it comes from short-term overreactions to negative news when price dips below value, and that happens a lot, as we all know, or underreaction to long-term change. And right now, based on my 30 years of experience, I think the way bigger opportunity is for people who are underreacting to what I think is massive change.
Great. Thanks for that background, and I think it's really helpful to set up our other topics that we're going to discuss today. So what I'd say, aside for interest rates and whether inflation is here to stay, the other big question is the debate on the value and growth and the cycle that we've been seeing there. After a sharp value run, and then we had some COVID fears with the Delta variant, you've started to see things switch back over to growth. Do you think we can expect further upside for value? And what is the possible impact of value, and how do you think interest rates will fit into that equation? And then I would say maybe an additional thing, sorry for the long question, but could there be a value cycle that doesn't include fossil fuels?
Yeah, so this is the real key question, obviously, and it's all related, and this is where we'll get into the slides. As you can see in slide 3, value has really had a swan dive of a cycle. It was, in fact, it's been the worst relative cycle for value in U.S. history. And late last year, value relative to growth, it got to a new 100 percentile. It set a new low watermark, which is pretty remarkable. And as you can see on the right side of the chart, and by the way, this just shows Russell 1000 value minus growth. It's very basic return. It gets a lot of traction. But on the right side of the chart, even before COVID and COVID-19 uncertainty, the value was doing very poorly. And then in March, it just absolutely collapsed. And then since then, as you can see in the far right, and really this happened on November 9th, the Vaccine Monday, as I call it, when Pfizer's data came out, we had recovery, we had value doing better. That's that little jump up at the top. But recently with Delta, it's rolled over, and we're not back to a low water mark, but we're at about the 95th percentile. So there's been incredible pain in what is considered sort of value. And the question, of course, is why? And this is the next slide. So the strongest correlation we've found, and our quant group with Farah Mustafa and company, they've tried to do everything, but looking at real interest rates on the next slide, this is the highest correlation to value. So the value underperformance is correlated highly with this. I think it's causal, but for now, we'll just say it's highly correlating. And really, what you're saying is the market is positioned for low rates forever. And by the way, real interest rates, it's just interest rates minus some measure of inflation. And what's remarkable to me is if you look at this right side is that the level of negative real rates are near all-time lows. For this last market cycle, they're near the EU crisis in 2012, and they're near the COVID crisis, if you call that period of uncertainty in March. I personally think this is nuts. Given the level of nominal growth that we're seeing, even with Delta, the health of the U.S. consumer, and just to mention that for you, Kathleen, there's an excess savings of about $2 trillion, and pent-up demand for foregone experiences, as we calculate it, we think it's about $600 billion. So there's massive pent-up demand, and then there's this massive shift in policy, which we'll get into, I'm sure, quite a bit. And by the way, U.S. corporate bond yields are also priced to record negative low real interest rates, and junk bonds recently have been crossed into negative territory for the first time. So what this means is that even with 2% inflation, you're going to burn through real wealth from this point going forward, and even in junk bonds and high yield. I think this is remarkable, and I don't think it's sustainable. Currently, the entire market, however, it's being held captive by this extreme and by the extreme positioning in real rates. And I'm not sure people realize how much the market is betting on a continuation of extremes. If you go to the next slide, on slide 5, as you can see, the correlation between growth and value, it's never been more negative. So what the market's doing between value and growth, with real interest rates, I think, being the driver, is you've never seen it this binary. All this is it's taking these factors, really as a style, growth and value, and you can see the correlations. As you can see, it's almost negative 1%. So you're almost at a coin flip. It's on any given day, you flip a coin, is it going to be growth or value winning, depending on what's happening with interest rates. Now, with interest rates moving lower on things like the Delta fears, interest rates come in and growth is one big. That's what we've seen lately. We're all aware of that. And vice versa. When you feel better about the recovery, if rates start going higher, value tends to rip higher on the style basis. And it's certainly clarifying, because you have no doubt in your mind what it will take for us to do well. If we get higher rates, and specifically real rates, our relative performance with how we're positioned is going to go well. Now, many of you are probably thinking, well, hey, there's no edge in macro, and this is just a macro beta bet. And I would argue, however, that the path of least resistance for interest rates is higher as the recovery continues and you get the full extent of the policy changes coming to bear. But I'll start by answering this with a simpler question. And I always ask this as a valuation manager. This is part of our embedded expectations. What's embedded in each of these? And so on slide 6, and all this is doing is taking that negative correlation between growth and value, and it's looking at the relative valuations of both sides of the bet. So if you start on the left side, this is the relative valuations of stocks that are positively correlated with treasuries. So the ones that go up with lower yields. This is mostly growth stocks, as you know. They've just gone exponential. So We were already having a good growth cycle, but these stocks have really blown out on a relative basis. And at the same time, on the right side, if you look at it, the stocks that are mostly value stocks that do better when rates are higher, they're near all-time valuation highs. So all you need to take away from this is that the market is really positioned, I think, more than people appreciate, for low rates forever. And as a result of this, cap-weighted indexes in the U.S., as we all know, they're near 2000 valuation highs, but it's the mean by the cap weighting that's skewed very positively. So the median stock is actually not that extended versus history, and the value stocks that we focus on are just downright cheap. And one of the key points of every market cycle is they always begin and ends with extremes. You have some extreme winners, some extreme losers, and the stocks just change. Living up to my grandmother's maxim of everything being cyclical, every sector gets to spend time showered in the glory of greed and then the downturn of fear eventually. 15 years ago, just to highlight it for people, and you all remember this, U.S. tech and mega cap were historically depressed. No one wanted them. It's hard to believe now. But people were sticking with their brick cycle love of commodities and emerging markets in 2008, 2009. And this cycle, the extremes just happen to be in traditional value names like financials and energy, where we have big overweights. And, to answer that question on the energy side, energy's leading the market so far. I think it's going to be very, very hard for energy not to participate in a value cycle, just because everything in energy, the simple rule is they're supply-driven cycles. And as I'll get into in a little bit, we're having one doozy of a supply-driven cycle. So I think energy is leading so far on the value side. We saw a big spike yesterday in the stocks, and I personally think it's going to continue. And I'll get into more reasons why, I think, in a little bit. Now, one of the things I want to point out, and this includes energy, people probably think, okay, you're getting paid a lot for this. That's great, Sam and team. But by buying this valuation, aren't you just buying really poor stocks, really challenged stocks? And I would say no. We have incredible balance sheet strength across the board. Our holdings are generating massive free cash flow. They're paying dividends and buying back stock. So both our portfolios are at about a 25 to 30% discount to their respective value indexes, but the forward growth estimates and the cash flows are actually above the expectations for the market overall. So we're literally getting paid a fantastic amount just to wait. If rates do indeed stay at low forever, we'll be fine on an absolute basis. You'll definitely want to own a gross fund, not us. But if rates go up for any reason, we should do very well, and we've demonstrated this with the few periods we've seen of value reemergence. And then the last thing on this, Kathleen, the key to this is that the spring for value, if there's one thing to take away, the spring for value is still at really extreme levels. So you've got these, we're close to the all-time watermark for relative valuation performance. And what I would just tell people is every cycle is like the Big Bang in physics, where you just get massive compression in some group of stocks, and then something causes an initial explosion, and you start to expand for what tends to be a very long time. It's always doubted, but I think the COVID recovery is going to be the match. I think that's already been lit, and we've seen early stages of this, but I think there's a really long way to go, and people just normally, they cling to the last cycle and they resist change. They underreact to change, and I think that's the behavioral error that's being made right now.
Thanks. Very, very helpful in understanding, especially a lot of these slides that we have for everyone and how you think about these. One thing that I think is getting a bit more, at least headlines, is ESG. So for some people who may not know what it stands for, but it's environmental, social, and governance investing. And for us at ClearBridge, this is something that we've been integrating into our fundamental research and our process, and this is our 34th year of doing that. I'd love to hear your view on how ESG is impacting the value cycle and the type of companies you're looking for that are expressed in your portfolios and populating the portfolios. And I think it would be helpful if you could share some examples to help us understand how it impacts the fundamentals of a company and their business value over time.
Yeah, absolutely, Kathleen. And this will this will also help that earlier question about energy and whether it needs to be part of a value cycle, and it's one of the ironies of ESG actually. But ESG is where I actually think we might have edge on calling for higher interest rates over this cycle. So hopefully I've convinced you all that you're being paid a ton to bet on higher interest rates. But I actually think that there's an ESG value cycle that once the full magnitude of the spending that we're going to need to do this to transition on energy, which is one of the core focuses, the core vectors for ESG, to address climate change and wealth disparity, I think we're going to get our value cycle. And why? According to JP Morgan and Goldman Sachs and some of the other big sell-side firms, and I've looked at the data, I think it's probably right, certainly directionally, ESG spending, related infrastructure spending over the next 10 years is expected to be between 20 and $30 trillion. That's massive. That's bigger than the brick cycle if you get into the higher range of those estimates. And I think this resolve was deepened over the summer with the extreme weather events all over the world. A year's worth of rain in parts of Germany and in central China. You obviously have seen the heat wave and the fires out west. So the resolve is bigger. And this is a massive shift in capital spending that's underway. So you're going from what I'd call weightless bits over the last 15 years as we spent out. We're really spending on cloud transition and software ate the world using that well-known and correct quote. And the massive shift that's coming in spending is going to be cleaning up heavy electrons, not weightless bits. And what I mean by that is we're going to be updating power grids, spending massively on renewable energy, as we know, and transitioning to electric vehicles just as one part of this. And the irony of this transition is it's very labor and material intensive. It's commodity intensive. And we're already seeing this, in my opinion. And at the same time, ESG is creating real fear and has drained capital from upstream spending on commodities, especially energy. So as a result, you're seeing these commodity prices strengthening all over. You're seeing inventories being drained, and yet there's very little supply response. And I think we're underspending in the supply response, even with ESG demand, slowing demand downstream. I've never in my life, and again, I grew up in an oil and gas business, I've never seen discipline like this from oil and gas and other commodity providers. And I think it's really the ESG fears that are creating this discipline. And so as a result of this, and this the irony is, free cash flow generation is exploding for these companies. They're paying down debt. Many of them are going to have net cash balance sheets, which is unheard of. They're paying special dividends to their investors, and they're enjoying returns on capital right now that are way above the cost of capital, even though their cost of capital in the case of energy is the highest in the market. So as this spending drives demand against shifting supply curves for material and labor, I just think that prices of things, of stuff, of heavy electrons goes up, and it takes interest rates with them. And the key is that none of this is priced into ESG valuations because they currently mirror the broad extremes. And according to empirical research, the ESG space in general, the names that score highly, they're trading at about a 30% premium to the market, while the most popular ESG stocks are at about a 60% premium. And keep in mind, as I argued earlier, U.S. indexes are at records that are almost as high as the 2000 levels, and you've got this huge gap. So anyone that's arguing that ESG isn't impacting capital flows and capital allocation, they're dreaming. It definitely is. And the opportunity for us as active value managers is that we have this massive valuation umbrella to play with in helping with this transition. And just so you know, just as one example, and I'll use power getting into your stock examples, Kathleen, pure play renewable companies traded about 17 times EBITDA. Transitioning utilities, which we own a couple of, traded about 9 times EBITDA. And the integrated oil companies are like 4 times EBITDA or thereabouts. So just to mention that, pure play renewables, 90% premium to transitioning utilities, and over 4 times that of the traditional energy companies. So there's this massive valuation umbrella if you can actually transition. And just to get into an example, renewable energy is going to grow at about a 12% CAGR for offshore wind, as an example. At a 12% CAGR, offshore wind will be the fastest growing 20%. It's a huge amount of capital that's going to be needed to spend in this. One of the transitioning power companies that we've looked at as an example, who has the ability to invest in this growth opportunity, we got involved, Gene, you and I, my partner on Value Trust, we got involved about 8 years ago, and the PE on AES was around 8 times. The C-suite got changed out. The new management team realized that coal had no terminal value for them, so they stopped investing and shut down coal, even though it sacrificed cash flows, which is pretty remarkable shift if you think you're being disrupted. They invested heavily in wind, onshore wind specifically, solar and industrial storage. They're also investing in liquid natural gas. And recently Google tapped them in the DC area, by the way. They tapped them for 24/7 renewable power. And AES is one of the few that can do this because they have industrial storage. And AES's multiple is now 15 times versus the 8 times where we started. But NextEra, which is an ESG darling, is around 33 times. So we still think there's a really long runway here, and these transitions just take a very long time. And one last thing on energy. We're engaging through our excellent ESG team and our analysts up in New York and our team here in making sure to try and meet the demand for energy while we transition, that they do it as cleanly as possible. And PXD and EQT as an example, they're going to try and get their methane emissions as close to zero as possible. This is huge because methane is 80 times more global warming potency than carbon dioxide. And so just getting this cut in half, which we think we can do by 2030, according to models, it'll lower the upside for warming from 0.25 to maybe half a degree Celsius, which is massive. So really, really starting there. So the point of this is you have these extremes. Those extremes in valuations extend to ESG. I think ESG is going from where it was to more of a value cycle because we have to spend a lot of capital in capital-intensive cyclical companies and renewables. That's part of what we're doing too. But to transition, and Kathleen, I just think it's going to drive demand for cyclical things, and that'll take interest rates up with it, and I think address some of these extremes that are currently built into markets.
Great. That's really helpful. Maybe if we move a little bit more towards from the higher level to now more the portfolio level. The one thing, again, as I introduced, I've known you for well over a decade, almost 2 decades, and I've been at the firm for about a little over 2 decades. But when I go back and look at 2020 and we come into 2021, the portfolio did have its highest turnover I've ever seen on the strategy. And I would say on top of that, the number of names that you've been holding in the Value Trust has probably been the highest since I've covered the portfolio. So if you wouldn't mind, share your thoughts on what caused that, and do you think it's likely to persist?
Yeah, so the short answer is 2020 was a remarkable year, and we were literally measuring, by the way, in those growth to value swings, we were having multi-year swings. Things that the magnitude literally used to take years was happening over a few weeks. So it was just an incredible amount of volatility. And if you're truly a valuation manager and you're thinking about underlying business values and prices moving around like crazy, 5x more than the underlying business value, you have to take advantage of volatility. So throughout history, when volatility spikes, our turnover spikes, and it always has been, always will be. And last year, Gene and I joked there were like 5 market cycles within last year. So we did it, and I'll use one example on that. On the vaccine Monday, when Pfizer's data came out and we had efficacy for their vaccine that was way above what anybody thought, we turned over almost 10% of the portfolio that day. So when things change, we change. And we definitely did, and so things like that drove it. Now we're transitioning back. We're back to more of our normal range, which is 30 to 40%. So like all of ClearBridge, we're long-term investors. We're multi-year holders of companies. We partner with companies, and so we're back to that. And I think we're in a new market cycle, and as that develops, we'll use the turnover to consolidate into higher conviction areas of the new market leaders, but the turnover will be much more normal.
Great. Thanks. That's very helpful. And so maybe we can talk about more recent portfolio positioning since we're almost three-quarters of the way through 2021. And if you look at how the portfolio is positioned, and you've alluded to this in some of your other comments, where you do have some overweights within the portfolio, in particular to the consumer side, consumer discretionary. If you look at financials, we talk about energy. But you're also a little bit underweight to some other areas like utilities and staples and healthcare if we look at how the portfolio is positioned. So could you kind of share what you're thinking on some of these sectors and how some of the recent maybe additions or some of the names you've been selling out of the portfolio have been reflected within the portfolio?
Yeah, so Kathleen, as I mentioned before, like everybody gets time in the hated list, the part of the big bang where they're so compressed, and the irony of this cycle, and people confuse this, it just happens that they're in traditional value areas. So the two cheapest areas of the market that we look at on any measure, we just think that it happens to be financials and energy and commodity related, and you're seeing that across the board. These companies too, not only are they cheap, but they have great balance sheets. They're generating massive capital and free cash flow generation right now. So in the case of financials, book values are compounding very rapidly, even despite the low rates. And then the free cash flow generation is incredible in our stocks. EQT, I used that example earlier. EQT's free cash flow hedged for 2023 is approaching 30%. I'm sorry, for 2022 is approaching 30%. So it's just remarkable. So you have these very good fundamentals on ROIC, and we just think that way below business value on both these. Energy stocks is another example to that earlier question. They're paying out special dividends, the one we own. They're going to have the highest cash dividend yields over the next 2-3 years of anything in the market, high single digits. And then finally, what's most important about this financials and energy, we're getting a very valuable free option. If I'm right at all that we're going to see the path of least resistance for interest rates being higher, and if there's an ESG-driven CapEx value cycle, and they're free because it's not priced. So financials will do better with higher rates, job one, and then obviously energy and commodities will be causal drivers of that. So I'll take it. Consumer discretionary, that's been our bet on this pent-up demand for experiences. I mentioned we think there's $600 billion in foregone experiences that are just waiting for Delta to soften, and they'll come out over time. So we think Delta has just softened and elongated the economic recovery, not stopped it. And we're getting a lot of volatility in the portfolio in consumer discretionary, so we're managing that, but that's still, that's a tactical play for us. Technology, you should always ask, it's so massive and broad. There's tech in everything, so there's always opportunities. And there's obviously great fundamentals here, but most of tech is trading at pretty high valuations. That's where you've seen the most valuation expansion, and they're pretty crowded. So we're picking our spots, and here we're playing turnarounds with really good management teams, CEOs that have great track records of turning around, and that's On Semiconductor as an example, DXC, which is in top 10 position. Those are the areas and that side. In healthcare, and this is where the cheapest defensives by far are the drug stocks, and that might be because of policy issues, but single-digit P's, in many cases, double-digit free cash flow yields. So we're playing more defense there. We're still finding less value in staples and utes. We have some utilities and staple exposures, but not as much. We're always looking. That could change, but for now, we're still betting on a Delta delayed recovery and getting paid a ton for this higher rate. So that's how we're positioned in the portfolio.
Great. Let's say one of the other areas that has been a question and things that I think have been in the headlines and people have been going back and forth on is inflation. And so that's been a really big topic. And I think with inflation, we've heard about all the supply chain issues causing some of those pressures. Is there any area of the portfolio that you have concern, and how are you thinking about inflation and how it works into your thoughts with portfolio construction?
Yeah, so inflation's the ultimate tail risk, and everyone's talking about it, but actions matter more than words. And as I hopefully demonstrated earlier in this webinar, markets are so clearly positioned for low rates forever, low interest rates forever, that if we get inflation, it's a big risk. And so one of the biggest debates we have is if the risk-free rate goes up with inflation, we also think risk premiums will go up. And so the tide will come down in a big way. We think we're positioning for it with value. That's the first thing, is that value has a shot at outperforming here and holding on to real value. And some of our names will be driving the inflation. So if you get real pricing power in this cycle, that's what we're focused on, and we think we're positioned accordingly. We think commodities will play a role, among other things, but we'll see. And then the key question is, will it happen? I'm not going to cop out on this. It could. I'm not saying 100%. I'm not saying, some high percentage. It's a tail risk still. But the key is that the journey will start with higher interest rates and will feel good, really good, as I think it requires some of this pent-up demand to be unleashed. And the big question, as you alluded to, is how will the supply chain respond? How will labor respond? Will the supply chain unglue itself? Will we get more of a labor response? And then we'll see. But certainly the first step in the journey is higher interest rates, and then we'll see if we cross that inflation Rubicon or not. But value is by far the cheapest inflation insurance out there, especially how we're positioned in financials and energy. And these options are definitely not priced at all, which is a little surprising to me, just because the probability is not as high as all the doom and gloom guys say, but it's probably higher than it's been in a long time.
Great. And then I would say one of the final questions we've gotten here is, and again, I know that the future is unknowable, but is there anything that you think could derail the continued recovery? I know there's been a lot of talk about tax hikes, especially from the most recent infrastructure plan that's trying to be put through. So anything that you think would impact kind of your views and the recovery that we're seeing in value?
Yeah, so, typically economic recoveries, they end on either higher interest rates or commodity spikes. And as I've kind of laid out, there's evidence that maybe that risk is rising, but, it's not deeply in the money now. And I just think that we've got a cycle in front of us that has legs. So it's going to heat up. We're going to get more economic growth, and certainly faster nominal growth than we've seen in the last cycle. So it's going to be hotter, but it's a while before, and clearly the Fed signaling it's going to stay easy and all those macro things signaling that they're doing. And commodities are spiking in many cases, but they're still tolerable from these levels. And I think we will see some supply response. This is limited. So we have room to run, but those are the two. Taxes, and I'm just going off the latest sort of tax issue, they're already getting watered down quite a bit to more what I would consider more reasonable levels. So I don't think that's enough to end the recovery. And that I'd put way lower on the risk than an inflation spike, higher interest rates, or commodity spike, Kathleen. Great.
Well, those are all the questions that we did get from everyone that's participated on the webinar today. We do appreciate everyone joining us. Hopefully, they got some insights into how you're thinking about not only value as a style, but inflation, interest rates, and how the portfolio is positioned over the past and where you're positioned today. So, Sam, appreciate your time. For everyone that is listening today, we appreciate your time. And if there's any questions that you have, feel free to reach out to your ClearBridge specialist, and we'll be able to help you out.